Welcome to 2023. Hi, everyone. Really excited about this episode. We're going to review 2022, but we're going to talk about what's coming up in 2023. We're going to make some predictions. We're going to talk about future content. We get some amazing things in this episode. Let's jump into it. Hi, welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me today, as always, is Christina Wyatt. Hi, Christina. How are you?
I am doing great, Darren. I am so excited for 2023 and all of the new content that we are going to be releasing. So I just want to remind everybody that if you're listening on your favorite podcast platform, you're going to want to subscribe and leave a 5-star review. And for those listening and watching on YouTube, make sure that you subscribe, hit that like button, and also the bell button so you know when new content is always coming out.
All righty. So let's start, Christina, with probably one of the most interesting and most watched things of 2022, and that's interest rates. So what happened in 2022 with interest rates?
So we saw our last interest rate increase as it was mid-December this year. So Bank of Canada announced a 50-point basis increase, so 0.5 up. Looking back, we actually started at 0.25% in March, and we ended the year at 4.25% with that Bank of Canada rate. So 4.25, a 4% increase from March until December. Rapid fire increase we saw this year with interest rates, which are really impacting those mortgages and people that want to lend. It's been a crazy year. I did check into our inflation rates, though. You know, they say that they say it goes hand in hand and that they're combating inflation with these rates. I did check those numbers, and we were down to 6.8% inflation in December. We're back at an 8.13% in June. So we did see those numbers come down, but a lot of people are asking, was that the last increase? Are we going to see more increases in 2023? Darren, what's your take on that?
Yeah, well, I think we can definitely say when it comes to increases, it's either going to go up a little more, go down a little, or stay the same. No, I really have no prediction. But what I love to do in these things, it's kind of like odds in gambling or odds in sports betting. I always assume Vegas is always right? The house always wins. So if you want to know who's going to win a sporting event, Vegas is going to have odds on who they're going to win, and Vegas is still in business because they seem to be right an awful lot of the time. In our business, we talk about actuaries. If the actuaries say this is going to affect your life expectancy, we believe the actuaries, they've got the data. So when it comes to interest rates, I think of the banks kind of like Vegas. Banks aren't in this to lose money. They're spending a lot more time thinking about what's going to happen, what's going on. And I think it's interesting if you look at the GIC rates out there right now. So this is one of the major banks. You've got 1-year GIC 5.06, but if you want to lock your money up for a longer period of time, they always pay more, right? Well, not anymore. The 3-year GIC is 4.75, and the 5-year GIC is down to 4.4. So they're actually giving you less money on a 5-year they are on a 1-year. And really what happens here is these long-term rates and the long-term mortgage rates, they really look at the bond curve. And a bond curve typically, it's an increasing curve. So we go, great, you sign up for 1 year, you're going to get this, 3 years a little higher, 5 years a little higher rate. But now we actually have an inverted bond curve. So the longer you lock in for, the lower rate you're going to get. So what that tells me is the banks believe interest rates are going to be coming down over the next number of years. So they're building that in, well, they're looking at the bond curve, but they're building that in. So, it's the first time, in recent times that you're actually being penalized for locking your money away for a longer period of time. And that's basically the bank not wanting you to pay that big interest rate for a five-year period, because they think if they can entice you into a 1 year, that's going to be better for them, because then all of a sudden you're going to get a lower rate next year. So again, I'm not telling people to lock into a GIC or invest in a GIC. It's interesting when we think, we expect interest rates to decrease, but I like looking at the interest rates that the banks are offering, and it looks like they're expecting interest rates to decrease. When that happens, can't tell you, but I think there's going to be good news. It's just when it comes.
Yeah, one of those indicators that we can look for, right? It's not the norm hearing that inverted yield curve. And you do such a great job explaining that, Darren, because you hear those words and you're like, inverted yield curve, right? Okay, what does that mean? Well, this is what it means. It's not normal. Our bonds are going down. They shouldn't be. But from an interest rates going up perspective, it could be a good indicator that we're going to see good news on that side, maybe in 2023. But from the sounds of it, by 5 years out, we're definitely going to be lower from their odds, from Vegas's odds, anyways, right? So, I guess good news there.
Good news
The
there.
next one for us. Oh, sorry.
Yeah, it's stock markets. We're going to talk about so 2022, what happened in the stock market. And again, we kind of got U.S. and Canada kind of slightly different numbers here, but they're both down. So what did the markets do in 2022 ballpark?
So it wasn't a great year for the stock markets. We saw about a 20% decrease in the S&P 500 and around, 9% or so in the TSX. So we ended 2023 in a down year. Now, good time to start thinking about the volatility buffer, guys. So, go back to, we got a podcast there on the volatility buffer you probably want to check out because it looks like next year is going to be a need. There's going to be a need for it. We ended this year with a down.
And then Bitcoin, yeah, same thing, down 65%, 16, 17,000 in that ballpark. We're going to have more podcasts on Bitcoin in 2023. I've been investing in myself and learning more about it to better help clients and listeners. So if we look at housing, if we look at like the GTA, which where a lot of our listeners and investors are putting some money, we saw that spike sort of February, March, and then it came down. But if we look at overall the year, GTA's housing prices were down by about 11%. But again, you go to different pockets of the GTA, it's gonna be different. There's some great real estate reports out there you can find online. I thought it was interesting. Condos again had that spike and then down, but 1 year basis they were only down about 1%. So they didn't see the same decrease in condos. But price drops are really, really concerning for investors and people that own homes or want to buy homes. Doesn't matter. Everyone's following the prices. But we've also seen some horror stories in the in this decreasing market. And Christina, you found or shared a great article with me the other day. Why don't you talk a little bit about that article?
Yeah, so for real estate investors, it's not going to impact you immediately dependent on what strategy you're using. And one of those strategies that are really going to feel this is pre-construction, right? So if you got into pre-construction at its peak and now it's time to go out and get that mortgage, and your mortgage, in your example, you purchased at 1.6 and now it's worth 1.3, that's not going to that's not going to work very well for you. And I actually saw an article there the other day. I shared it with you, Darren, about a pre-construction community in the Brampton area where these individuals aren't able to go get those mortgages. So one, they're not, they've got to come up with a lot of extra money because they need to get approved for this. They've got to come up with 300 grand, maybe, your example is actually bang on to what the article was saying. They've got to come up with a 300 grand. And also when they were doing out the math on what their mortgages were going to be, they were incorporating like 2% interest rates. That's having your, $2,000 mortgage go to 14 or go to 9,000. Like it was big changes for them when looking at it. And it's going to have an impact on how that pre-construction plays out. I don't know what kind of clauses, if they've got an assignment clause built in there for them to sell. On one hand, it's very bad for these real estate investors. On another side, I do think there's going to be some opportunities for other real estate investors when we're looking at these things happen.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Yeah, I mean, the reality is every time there's a crisis, on the flip side, there's a massive opportunity for somebody, right? But yeah, I mean, they bought these homes thinking they were worth this and they could qualify for the mortgage and the mortgage payment was going to be this, but all of a sudden it's a couple of years later and now the homes aren't worth as much. They can't get the mortgages or can't afford the mortgages. They don't have an out clause. They don't have an assignment clause in that. Goes back to the importance of the assignment clause we talk about in the pre-construction podcast coming up. So just some horror stories. You gotta be careful. You gotta be smart. You gotta know what you're doing before you buy some of these places. Industry news, Christina. What do you want to talk about? Industry news. We do have some exciting stuff coming out to share on that.
Yeah, so last month we mentioned that Manulife was working on coming out with their client portal and having all of the information that we needed available on it. And they came back. It was a Merry Christmas to us because they let us know right at the end of the year that what we need, what we want to see for clients is now available in there. So for our clients, make sure that you check your inboxes. You are going to be getting an email with step-by-step instructions on how you can sign up for that portal if your policy is with Manulife. You're now going to have that online access, which I know we've all been asking for. So super exciting news, and we will definitely be sending out instructions on how to get that all set up for you.
Cool. And then the other thing, I just want to go back to that disability. We've talked about it a few times. When we were down in Florida at a conference, 4 insurance companies talking about the massive spike in disability claims, and we talked in a previous episode months ago about Manulife no longer selling personal disability. They're still doing group disability. If you're on disability, you're fine, but new personal policies. If you have an existing policy, you're fine, but they stopped selling them. And we speculated why, but I found it really interesting that mental health claims are the cause of the massive spike in disability claims. So right now, about 30 or 40% of all disability claims fall under the mental health, and about half of those would be for depression. But that's a significant spike in the mental health claims. So, if claims are going up, it's just a matter of time before premiums go up, and those disability premiums on a personally owned policy, those lock in for life. So the writing's on the wall. Disability rates are going up. It's just a matter of when. So if you're on the fence about a individual disability plan, reach out and you can have a chat with one of our wealth coaches. But it just makes sense. That's going to go up. If claims are up this much, rates are going to go up. It's just a matter of time. And when the insurance companies lock in rates for life, they'll probably act sooner rather than later.
Yeah, that's it's interesting stats that we saw come in there on the disability side of things. And it's a great time to go back and take a look, review your protection planning for you and your businesses. 2020, we're in 2023. It's a great time for reviews, looking back, making sure that you've got all those different pieces in your planning, and disability is a big one, right? We say it all the time. You are your greatest asset. You are going to make the greatest returns for you throughout your lifetime. You want to protect that.
Cool. Okay, and then Christina, you want to do that question now?
Yeah, so we want to do some CS as a control and compound update. We have decided in 2023, we are going to pick a question from social media. We get a lot of questions out there. We try to get them all answered. But we want to share some of these commonly asked questions with you, and we want to get them answered on our update. So each update, we are going to ask one of the questions that a listener has asked us, and we're going to provide that answer. So here is our first question, Darren. It is, I'm in Canada. I inquired with a life insurance company about infinite banking. They told me only after I maxed out my TFSAs, or tax-free savings account. Is this good advice?
Great question. So again, it's kind of like walking into a bank and asking a teller what you should do with your money. Like if you call an insurance company, the person answering the phone is perhaps not someone you should be banking on for all your financial advice. But I'll give you my thoughts on TFSAs, RSPs, infinite banking policies. So, I love infinite banking policies. I really like TFSAs. I'm not an RSP fan. Deferring your tax till later or locking up your money for 20, 30, 40, 50 years for an entrepreneur, for a real estate investor, for a business owner, I just don't think it's a great strategy, and we can expand on that in another podcast. TFSAs, I love. The issue with the TFSA kind of works similar to an IBC policy. It's after-tax money goes in, it grows tax-free. When you take it out, it's tax-free. Same idea, okay? Doesn't come with a death benefit, but same idea. The problem is most people go into TFSAs they're going to go in for an investment and they're going to say, great, we're going to put this in and it's going to grow. Well, if the stock market drops 20 or 30% like it did last year, are you really going to access that money for an opportunity? And that's when opportunities present themselves, typically when the markets are down. So the great opportunity comes along and you don't have access to funds because it's an or asset. I put money in my TFSA, or I do real estate, or I buy a car, or I invest my money in the stock market, whatever. Versus an infinite banking policy, more of the savings approach where we're going to save money there in an uncorrelated asset. So when the market drops, cash value life insurance isn't going to drop. So when those greatest opportunities come along, when things are down, your cash value life insurance is not going to be down. It's guaranteed to go up every year. So I can put money in an IBC policy, infinite banking policy, and I can leverage 90% of it to go do real estate, buy the stock market when it's down, buy Bitcoin when it's down. I can have an and asset. My money's in two places at the same time, plus providing a death benefit and all those other advantages of an infinite banking policy. So in my hierarchy, it would be infinite banking policy is sort of step one, TFSA step two, RSP be around step 406. No, I'm joking. But, step one, infinite banking policy. Step two, TFSA. That's personally what I love. I love those two things. And, for my kids, that's what I'm going to talk about. And we're going to do a whole podcast this year on what young people should do starting out. So any comments on that, Christina?
Great answer. The only thing I kind of want to add is that you're not comparing apples to apples when you look at a tax-free savings account versus your infinite banking policy, right? Tax-free savings accounts or TFSAs are great for investing. They are the perfect place to invest. I love them just as much as well. But they're an investment account, whereas your IBC policy is your savings account, right? So this is where we're saving for our opportunities, emergencies, as they come up. You need that fund, you need that savings account, and then you want to go out and you want to use your investing account. So really, you're right. Step one, save. Step two, invest. Tax-free savings account is a great place to invest, but not your first stop.
Perfect. Okay, and then Christina, what about podcasts? What do we have last month, and what do we got coming?
So last month we had some really great guests on the podcast. We had Jesse Berger come and talk about Bitcoin. That one was awesome. We also had Alfonso from Wealth Genius come in and chat about real estate and growing his real estate portfolio. And then we had our frequently asked questions part number 2, which I've had a lot of feedback on people enjoying that one because it does answer a lot of commonly asked questions. So I encourage you to check it out if you haven't already. And then we had one on how the banks make money, which was interesting as well. So we had some great podcasts to end the year, but we got some even better ones coming up. Darren, which ones are those?
Yeah, we're really excited about 2023 for the podcast. We've got a series of real estate focused podcasts in combination with infinite banking. So we're going to break down different strategies to invest in real estate and how an infinite banking policy in combination with the real estate can just make it a lot better. We've got a plan. So there's going to be lots of content coming out in 2023 for real estate investors. We have some great guests set up as well. So that's what you have to look forward to in the next few months. We love hearing feedback. Some of our podcasts were from feedback from listeners. So if there's something specific you want to talk about, reach out to us and say, hey, we'd love to hear something about this or that. So we're really trying 2023 to really grow this podcast to just provide a wealth of information to our listeners. And we're pretty excited about the year. All right, everyone. Thanks for watching. Thanks for listening. We'll see you next time. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.